So last month in January, $40 just showed up in my account. I didn't work for it, I didn't sell anything, and I didn't trade. I just owned a few dividend stocks inside my TFSA, and the money came in automatically. Now $40 is not life-changing, it's not a big amount, but it's a real number. And the crazy part is that the number keeps growing the longer I hold. So if you have heard about dividend investing, but you are still confused how it works in Canada, like the real numbers, the payment dates, and how the TFSA fits in, and what happens with the taxes, I'm going to break down in simple language and show you exactly how this works in the real life. Let's first start, what is dividend? So when you buy a stock, like TD Bank, Ambridge, you actually become a small owner of that company. For example, if you buy shares of TD Bank, technically you own a tiny piece of TD Bank. Now when that company makes profit, there are few options. First is they can reinvest into growing, like big tech names, Nvidia, Apple, Microsoft. Second is they can buy back their own shares. The third option is that they can share the profit with their investor. So when they share that profit with you, it's called dividend. It goes directly into your investment account as a cash. So you don't have to sell anything, you don't have to do anything, you just hold the stock and they pay you. And not every company pays dividend. Usually the bigger, more established companies do, like McDonald's, Walmart, Coca-Cola, Pepsi. And in Canada, many banks, utilities, and pipeline companies do. And we will get into real examples in a second. So let me give you a real Canadian example so this actually makes sense. Let's take TD Bank. So TD pays dividend every quarter, 4 times a year. And let's say they pay $1.05 per share. If you own 100 shares of TD, that's about $105 coming into your account every 3 months without selling a single share. And that's $420 per year just from holding. Another popular one in Canada that I personally own is Enbridge. So they are a pipeline company very well known for dividends. And they have been increasing their dividend payment consistently for years. And I actually talk about my top 3 performing dividend stocks in my last video. If you want to see exactly what I'm holding and why, the link is in my bio. So another important thing is the yield. So the yield changes as the stock prices move. If the prices goes up, yield goes down. If the prices drop, yield goes up. Even if the actual payment stays the same. So when I was owning Fortis at $53 per share, the yield was about 6%. Now that the same stock goes to $77 per share, the yield is about 3.50%. So when you're comparing stocks, always look at the yield. It's more accurate comparison than just the dollar amount. So here's the mistake that I want to help you avoid, because I see the beginners fall into all the time. When you search for dividend stocks, you'll see the yields of 15%, 20%, even 25%. Happens every time, and your first thought will be, wow, that's amazing. But I want you to be careful that a yield that is high is usually a red flag. And here's why. If the yield is 20%, it usually means the stock prices has dropped a lot. And that often means the company is struggling and they cut their dividend. Sometimes they remove them completely. If you don't get that 20%, you end up with a loss and no dividend, and that's not great. The most reliable Canadian dividend stock sits between 3% to 6%. So here's something most beginners don't know, and it actually matters a lot. There are 3 key dates for the dividend. First is the declaration date. This is just when the company announces that they are paying dividend. So the companies that pay quarterly, they announce it. The companies that pay monthly, they announce it every month. Second is the ex-dividend date. So this is the most important one. You need to own the stock before this date to receive the payment. If you buy on or after this date, you miss it. And the ex-dividend date, if you, let's say, buying a monthly dividend stocks, is usually 2 weeks earlier. Third is the payment date. This is when the money actually lands in your account. So if you're buying the stock specifically for a dividend, check the ex-dividend date first. That's the one that matters. Now let's talk about another important thing, tax-free savings account. So you pay 0 tax on your dividend. The money comes in and it's yours. So that's actually where I hold most of my dividend stocks, my tax-free savings account, mostly Canadians. Because it just makes sense to keep the income completely tax-free. If you hold them in RRSP, dividend growth tax deferred, so you don't have to pay tax now, but you pay later when you withdraw. And if you hold them in regular, non-registered account, dividends are taxable. but Canadian eligible dividends actually get special tax treatment, and the effective rate is usually lower than you think. My suggestion is, if you're just starting out, open your tax-free savings account first and start there. It's the simplest, most beginner-friendly one. Now another big question is that how much money do you actually need to live off dividend? So let's be honest with the numbers. And if you want $30,000 per year, let's say around $2,500 per month at a 5% yield, you need around $600,000 invested. That's a real number. And I'm not at that point, and most people watching this aren't either. And that's totally fine. The goal early on isn't to replace your income. The goal is to start, build the habit, and reinvest everything. And let the time do the work. My $40 a month proves the process is working, even if it's small right now. Next month, that $40 will be $43. Next year, that will be $80. So it will keep growing. The numbers grows every month because I keep reinvesting and adding. And even $5,000 invested at 5% gives you $250 per year. And as I mentioned, I made $40 in dividend last month. So this is coming from my tax-free savings account, from dividend stocks that I have been building up over time. Not all at once, I have been adding it slowly but consistently. And $40 is again not a huge number, but here's what it actually means to me. It means my investments are working. Even when I'm not doing anything, even when I'm busy, that money comes in on its own. And the plan is keep reinvesting through drip method, which I'll explain in a second. Now let's talk about something I personally use. It's called drip method. So dividend reinvestment plan. Now here's how it works. Instead of your dividend coming to you as your cash, your broker automatically uses that money to buy more shares of the same stock. So more share means your next dividend is bigger. And that bigger dividend buys more share, and it just keep going like a snowball effect. And that's compounding. And it's how small amounts turn into real money over time. On Wealthsimple, you go to automation, then dividend reinvestment, and just turn it on. Most Canadian brokers have this. And it's usually free, no commission fees to reinvest. So every dividend payment automatically works for you. And one more thing before I wrap up, a quick tip for finding reliable dividend stocks. So there are companies that have been paying and increasing their dividend for at least 25 consecutive years. And when the company has kept paying through recessions, market crashes, pandemics, that tells you something real about how stable they are. So it doesn't mean that there's zero risk, but it's a solid starting point when you are researching what to buy. So that was dividend investing in Canada explained in simple language with real numbers. And if this helped you, drop a comment below. Let me know where you're starting from, even if it's zero. We all started there. If you like this video, please give this video a thumbs up and subscribe to my YouTube channel.